Joining me now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, good to see you. What do you make of this $2 trillion club? Amazon joins the club, Lee.
You know, every single company that you put on that board there, they rely on China for their marginal growth to keep these massive multi-trillion-dollar things. Now, think about what Amazon's doing. I know it sounds great. Temu Shane, here's the thing. It's not just about the products. Amazon is competing, and it sounds crazy when you say it, mind-controlling, algorithms, like we've seen what happens to teenagers with TikTok. That's what these little Chinese apps are doing. So I think it tells us two things. These algorithms that are selling products are dangerous and addictive. Number two, big American firms are relying on our relationship with China to break into that market, to keep that market share. I'm very concerned because both presidential candidates are talking about continued and heightened tariffs with China. It makes me nervous as an investor.
Yeah, I understand. And not only that, but we don't really know what kind of information these Chinese companies are getting from the public, right? Aren't they, forced to send any information in terms of our data to the Communist Party, the government of
Yes.
China? Yeah.
And we have all these large companies that are going to be complicit in that because they want to make their quarterly numbers. They want to try to break into there. So just the general commerce information. I don't need the Chinese government knowing every single thing that we're doing all the time. It makes me uncomfortable, and I think we're going to have to rethink about how these large companies are going to continue to grow. Same thing with Apple, same thing with Tesla.
Yeah, absolutely fair point. I reported on it in my new Fox Nation special, by the way, Underwriting the Enemy. There's all these Chinese stocks trading on exchanges. They don't even follow the same accounting rules as every other public company. But I want to get into the banks with you this morning because, of course, as you know, the Federal Reserve conducted its annual stress tests for America's major banks. And the Fed says all 31 banks would be able to withstand a severe recession. Federal Reserve Vice Chairman for Supervision, Michael Barr, said, quote, large banks would take nearly $685 billion in total hypothetical losses and still have considerably more capital than their minimum common equity requirements. Lee, what did you make of the stress tests and the reaction from the major banks yesterday?
Well, obviously, I'm encouraged it's only going to cost us $650 billion and not multiple trillions like it did, 15 years ago. Here's what I'm concerned about. First of all, that we can shrug this off so easily, that we have such confidence. But 2 weeks, we're going to see bank earnings. All we're going to hear from the major banks is that credit card balances are going up and the rich can continue to pay fees and continue their bills. What I don't hear in the stress test is any talk about all the private credit, because I don't think in 2 weeks we're going to hear major banks talking about their loan books expanding dramatically. I think there's a lot of risk in private credits. As an investor, I got to manage money for people who are retired, live off their money. I think that I'm getting more questions about what's outside that, and I don't think the Fed is spending enough time stress testing all the private credit, all the money going in there, because that will have a trickle-down effect. It's unclear how that will affect banks. It's a big unknown.
Yeah, it's a great point. And the analyst over there at TD Securities, Cowen and Company, says it's not all good news for the banks, even before we get to the exploratory scenarios, which we still see at the long-term threat to bank capital returns. He says it is why we do not see this altering the final outcome for Basel III endgame. So we've still got some questions about the major banks. Would you buy the banks or broaden out at this point? I want to bring Mark Tepper in because Mark and I have been talking for a while now about this market inability to broaden out, Lee. Mark, how do you see it?
Yeah, and I want to get Lee's take on it because I don't want to sound like a complainer, Lee. The market's up almost 15%. We're not even quite at the halfway point just yet. So it's been a great year. But once again, it's the Magnificent Seven minus Tesla, which has been doing all the heavy lifting. Small caps haven't been participating. The other 493 stocks in the S&P really haven't benefited much from this rally. What do you think it's going to take for this rally to broaden out? Will we see some broadening out if the Fed ends up cutting rates, or is there another catalyst that can kind of help this rally to strengthen and broaden out?
Oh, God. Can we just complain together and just be in the complainers club? I mean, here's a problem. I was thinking we were getting 5,200 by the end of the year. I said that in January. People roll their eyes, right? Now we're almost at 5,500. We only are expecting 260 a share from the S&P, and we have such a high valuation now. We're not even leaving any room for next year. Here's my issue. What am I supposed to do as an investor? I'm already getting a valuation that gets me into next year. but I haven't seen the earnings from those companies really trickle in outside the Magnificent Seven. So we've had narrow rallies before. I don't really like it, but I think that the only way that we're going to get the other companies to come up, because I'm not convinced everybody's just going to sell their AI stocks if we, get a little less demand in chips from NVIDIA. We have to see the availability of money or the idea of it get better. And we've got to see rates go down. We're still in an either or market where you have, widow and orphan stocks, the stocks I love, value stocks, compete with the Magnificent Seven. It's all about interest rates. And also, let's be honest, we've got to get past November. Wall Street doesn't want to talk about November.
Great point. Real quick on the final read of first quarter GDP. It's out this morning, 8:30 a.m. Eastern. The expectations are a 1.3% growth. Lee, we'll also get, of course, the Fed's favorite inflation measure tomorrow morning, the PCE index. Economists are expecting core prices to be up 0.1% month over month and 2.6% year over year. Do any of these economic reports affect how you view the second half of the year, Lee? And real quick, even more short term, if Trump does well tonight, do we see a market rally? If Biden does well tonight, do we see a market impact? Any thoughts there on the debate?
I think the market has already priced in a Trump win, lower corporate taxes, et cetera, et cetera. I think when we see GDP numbers, I really want to see an annualized 3%. I think tomorrow with PCE, if we get any hot print, it's not going to be good. I think the market at almost 5,500, we're pricing in nice, cool prints. I'm worried about the sound bites tonight. I'm worried about the perception, not about who's in the lead or who wins. I worry about anything that would suggest we're going to have a problem when we wake up Wednesday after the election. It's all about acceptance and certainty of a winner. I think it's less about who wins. But market's priced for a Trump win, bottom line.
All right. We will leave it there. Lee, good to see you. We'll be watching all of that. Lee Munson joining us this morning. Have a great day, Lee. Thank you. Your morning move.